Very nice to see everybody. I see quite a lot of familiar faces and people from my past around, and that is also very exciting. On many counts, economic performance has been disappointing since 2007. Average GDP growth has been 1% compared with 2.7% in the previous 15 years. The ratio of national debt to GDP has risen from an average of a little over 30% during the previous 15 years to 95% today. Interest payments have become a significant expenditure item and now account for some 10% of government revenues. And recently, inflation touched 11%, the highest rate since the beginning of 1982, and remains stubbornly above the target range. As Tim said, it's now over 60 years since I first became actively involved in economic forecasting at the London Business School. And during those years, I've observed significant changes to monetary and fiscal policy framework. And I would like to begin by describing my perception of the main aspect of those changes. I will then examine the main inflation episodes over those years before trying to answer the question, could we have done better since 2007? For me, there have been four distinct policy phases in the UK over the past 60 years that I've been working. This is highlighted by the movements of long-term interest rates in the major countries. The first phase, ending in 1972, turned out for me to be the breakdown of Bretton Woods. Interest rates were increasing, but the leading economies were still bunched reasonably together. The second phase, from 1972 to the late 1970s, for me demonstrates the consequences for economic management of the absence of an inflation anchor. Interest rates soared, they were volatile, and they varied a great deal between countries. The third phase, from the late 1970s to the early 1990s, I think of as the search for a new monetary anchor. This included monetary targets, medium-term financial strategy, and the failed membership of the exchange rate mechanism. Interest rates remained high by today's standards, but volatility was reduced. There were signs of rates in different countries coming close together as we went through that period. And the final phase, from the early 1990s onwards, is for me the age of inflation targeting and independent central banks. Long-term interest rates fall steadily. They closely bunch together until 2020 when they pick up again. And I propose to say a little more about each of those phases. The first period covers my early years in model building and forecasting at the London Business School. These turned out to be the final years of the Bretton Woods system, which had provided the post-war inflation anchor. Discipline was imposed by the policy changes needed to deal with any balance of payments problems, and for most of the post-war period, this worked reasonably well. The 1967 sterling devaluation was the first sign of impatience with the constraints of this system. The view developed that growth could be improved if we devalued to make exports more competitive, thus easing the balance of payments constraint. UK devaluation was followed by French devaluation, and the system effectively came to an end with suspension of convertibility of the US dollar to gold in 1971. The inflationary impact of the 1967 devaluation was underestimated, and by the middle of 1971, UK inflation was close to 10%. Sterling floated along with the other currencies in 1973. That takes us to the second phase, and along with other countries, this effectively, for many of them, left them operating, and certainly the UK, operating economic policy without an inflation anchor. Inflation control at that point centered on attempts to prices and incomes policies, but they did little more than postpone inflation pressures. In the UK, the introduction of competition and credit control in September 1971 sparked a sharp increase in money supply and a house price boom. Fiscal policy was also aggressively expansionary. The external environment was also inflationary, with faster growth in other countries driving a worldwide commodity price boom. In the autumn of 1973, the Arab-Israeli war broke out, and we had a massive oil price increase. By 1975, many countries were experiencing high inflation, but the UK's peak rate of 25% was significantly worse than other large economies. Furthermore, by this time, the level of government borrowing had become a major issue. In the following year, the UK government called upon the IMF for help, and the search began for a replacement inflation anchor. Control over domestic credit expansion was the centerpiece of the IMF program to deal with the UK's problems. They were conditional, those loans, on substantial public expenditure cuts, and it really became the time that the emphasis of fiscal policy shifted towards supporting monetary policy. These events raised significant questions about the conduct of policy and the forecasting models. It was during this period of reevaluation, as Tim has said, that I first met Tim Condon, and we started to debate issues of monetary and fiscal policy. It was also when I started to work with Alan Budd in trying to build on the experiences of this period for our research work and the structure of the London Business School model. And this, Tim has mentioned, drew us towards the proposal for a medium-term financial plan for monetary and fiscal policy aimed at bringing down inflation and restoring the weaknesses of public finances. Phase 3 runs, in my mind, from the late 1970s to the end of 1992. This was dominated by, for me, the search for an alternative inflation anchor supported by fiscal policy. And for most of this period, I was in the Treasury. Monetary targets were introduced in the late 1970s and were toughened in the early 1980s. However, the attempt to implement strict monetary targets proved challenging for the UK's new government, particularly following the ending of the corset arrangements for controlling growth of bank lending. Broad measures of money supply continued to grow rapidly, but other indicators suggested that policy was very tight. At the same time, the medium-term financial strategy was introduced in the budget of 1980, and it continued through the years of the Conservative governments. Its aim was to establish a sustainable path for fiscal policy that supported monetary policy. The tough 1981 budget was designed to cement this strategy. And there were also changes to the public expenditure control system with a move to cash budgeting rather than real terms control that had been used for most of the post-war years. Throughout the 1980s, exchange rate volatility posed major problems. For the UK, this was partly due to the significant emergence of North Sea oil, but the main factor was the huge variation in exchange rates between the US, Germany, and the UK. This generated increased international interest in managed exchange rates and greater interest rate coordination. In the mid-1980s, the Plaza Agreement was designed to lower the dollar. It was followed by the Lula Accord, which was aimed at stabilizing the dollar. Both were important events, and this volatility of exchange rates also stimulated Nigel Lawson's interest in joining the ERM as an inflation anchor. Despite the success in bringing down inflation in the mid-1980s, inflationary pressures emerged again, together with a further oil price hike in 1989, and this combination took inflation to over 8%. The UK joined the exchange rate mechanism, but rising German interest rates put further pressure on the UK at a time when UK domestic conditions pointed to lower interest rates, and this led to Black Wednesday leaving the ERM. This takes us to phase 4, and this is the age of inflation targeting. I was permanent secretary of the Treasury for the period until mid-98, and then was chair of Santander UK for some years between 2004 and 2015. Within weeks of leaving the ERM, Norman Lamont established the inflation target regime, along with a degree of semi-independence with the Bank of England. The bank was required to publish its own inflation report, free of the hands of Treasury sub-editors who had operated on these in previous times. We had a regime of monthly monetary meetings between the Chancellor and Governor instead of the existing practice of ad hoc meetings. And at a later point, Ken Clarke, as Chancellor, took the decision to publish the minutes of these meetings, and the famous Ken and Eddie show was born at that point. Before joining the ERM, the Treasury had examined the case for an inflation target. However, there were credibility challenges at that stage in setting a specific target given the level of inflation. And from the outset, there were also concerns that the long lags in the effectiveness of interest rate changes would put too much emphasis on the forecast of inflation. There were also worries that it would lead to too much weight being given to cost pressures and too little weight given to monetary and financial flows. However, the arrangement in the end settled down very well for the rest of that parliament. And in 97, following the election of a new government, Gordon Brown legislated, of course, to give a new monetary policy committee, the Bank of England, operational independence to meet a target range for inflation, which was set by the policy. I regard this regime as a success for almost the whole of the period until 2022. Inflation was close to target, even though the challenges to the authorities were very different before and after the 2008 financial crisis. Credibility increased as it became clear that interest rate changes were being taken in relation to the target. There was no serious conflict in the messages coming from monetary indicators and other forecasts. In addition, world conditions were very helpful, with an absence of shocks to world prices or inflation in other countries to disrupt matters. And of course, it was also helped by the rise of China, putting downward pressure on prices of manufacturers. The major changes in that period of fiscal policy were rather less stark, but they came with the introduction of fiscal rules in 97 and with the establishment of the OBR and the Charter for Budget Responsibility in 2010, with a more complicated fiscal remit. Next, I would like to make some observations about 4 inflation episodes over this period. That is, I've classified as being periods when inflation was clearly above 5% for several quarters or more, and the significant fiscal correction that followed 3 of them. This chart of US and UK inflation, for me, demonstrates the similarity in the overall shape and timing of the inflation episodes, with the inflationary upswings highlighted. So the peak of the first inflationary upswing was in the autumn of 75, the second in the spring of 1980, the third in the autumn of 1990, and the fourth towards the end of 2022. And although I treated them separately, the first and second episodes, of course, come very close together. And it's worth remembering that apart from an 18-month spell in 1978-79, inflation was in double figures from the autumn of 1973 until the spring of 1982. These episodes have several features in common, as well as some differences, again, in the way that I have looked at this. All 4 of the inflation episodes were preceded by or coincided with strong growth of the broad money supply. On 3 occasions, financial deregulation played a part in money supply growth. We had competition and credit control in 1971, the ending of foreign exchange controls in the corset in 1979-80, and Big Bang in 1986. The most recent inflation burst, of course, was preceded by an acceleration in money supply growth, but on this occasion, it was driven by an expansion of bank lending to the public sector, the consequences of QE, more than bank lending to the private sector. In a modern banking system, I think this is as close as it gets to printing money. Fiscal conditions also played a part. 2 of the inflation episodes were preceded by active fiscal loosening, the expansionary budgets of 1972-3 and 1987-88. The 1979-80 inflation spike was exaggerated, in my mind, by a major switch between direct and indirect taxation, even though there was no active loosening. The 2022 inflation episode was preceded by a substantial increase in government borrowing to fund lockdown, various support programs, what you might call passive fiscal loosening rather than active. And I should mention, just to complete the picture, of course, there was a major increase in borrowing in 2009-10 because of the need to support the banking system. Inflation did increase, but it didn't get much above 5%. My next point is that all 4 inflation bursts were made more severe by international energy prices associated with political and military conflict. Furthermore, in 2022-3, there were additional international shortages because of the interruption of supply lines following COVID lockdowns. And generally, the international price shocks come after the initial emergence of inflationary pressures, but they do make an impact. These inflation episodes were common to most of the advanced industrial countries, although in each case across those episodes, the UK was either at the top or close to the top of the inflation league table. I think much commentary underestimates the similarity between the patterns of inflation across countries in these periods. There were also significant fiscal corrections following the first 3 of these inflation episodes, In the mid-1970s, after the agreement with the IMF, in the early 1980s in the form of the 1981 budget, and some generous help from North Sea Oil, of course, and finally in the early 90s after leaving the ERM, each were directed at seeking to ease the pressures from interest rates into stabilized debt levels. The first three inflation spikes were followed by recessions, which I tried to show in this chart. 1974, 1980, 1991. The financial crisis was also followed by a recession, but the inflation spike, as I said earlier, was less severe. In the case of the 2022 episode, the recession was, of course, the direct result of lockdown, and it preceded the inflation spike. Now, for me, there are many lessons from these different policy regimes and from these inflation episodes, and I'm going to deal with them briefly. For me, the first and most important lesson is the need to maintain a credible inflation target. The period in the 1970s without an effective inflation anchor was very damaging in both economic and social terms, and it took many years to correct it. Secondly, money supply and other financial indicators should have an important role in informing policy decisions to meet the inflation target. Repeatedly, mistakes were made by ignoring these messages, even if there were false alarms at times. Lags in the operation of monetary policy mean that the policy response is often too slow. Furthermore, there are often differences in the signals coming from different indicators. These are challenging facts of life which suggest that when credible signs of inflation do appear, action should be early and decisive. Fiscal policy should support monetary policy. Normally, this means pulling in the same direction and avoiding making the task of setting monetary policy more difficult. The biggest challenges for the operation of fiscal policy are variations in the growth of output and the difficulty of measuring trend output. These variations complicate the assessment of both taxation and public spending and can often be a cause of mistakes. When fiscal corrections are needed, they should be decisive, as was the case in 1976, 1981, and 1993. On those occasions, action was taken both in respect of reductions to public expenditure and increases in taxation. Changes, as I've mentioned, to financial regulation have played an important part in monetary behavior through the impact on bank lending. Regulation is not usually classified as an instrument of monetary policy, but changes can have, and we have seen have, a considerable impact and require closer attention than has often been given to. Sharp movements in exchange rates can complicate monetary assessments and give different messages at different times. Again, they should not be ignored, but nor can they be relied upon as a single indicator. And forecasting errors are inevitable. That's the reality of life. And margins of error need to be built into the policy framework to deal with those errors and surprises. And my final point on these lessons is that the sharp falls, and it's always something that's worried me, the sharp falls in inflation in both 1980 and 1992 happened when policy was tighter than intended. The first was because of misleading signals from money supply figures, the second from a requirement to remain within the ERM. So applying these ideas, I now propose to look in turn at three policy areas and ask if they could have been done better since 2007. First, I will question how far the financial crisis and the resulting changes to banking regulation have contributed to slower economic growth over the past 18 years or so. I will then look at the conduct of monetary policy, including the emergence of quantitative easing as a policy instrument. I will question why it took so long to identify the emerging inflation in 2022 and to respond with higher interest rates. Finally, I will question whether there has been too much delay in addressing the consequences of the steep increase in national debt ratio following the two crises. Trying to answer these questions, I am fully conscious of the danger of hindsight. I've made my fair share of mistakes over the years, and I know only too well that reviewing possible mistakes is not the same as making decisions in real time. However, during a weekend conference last winter in Hay-on-Wye, organized by something called the Library of Mistakes, I was reminded that discussing possible mistakes can be a useful framework for thinking about issues. I should also declare that I am a shareholder in Santander and a former chairman of Santander UK. Some of my comments reflect my experiences during my time. Before embarking on these questions, I'd like to make some observations about the scale of the slowdown in growth we've seen since 2007. Since 2007, the growth rate for the major economies collectively has been less than half of what it was in the period between 1992 and 2007. The figures for individual countries are shown in the table. There are special factors between countries, for example, Brexit in the case of the UK, but for me, it is the similarities that are most striking and interesting than the differences. This is relevant because in discussing the policy questions I've listed, we have to keep in mind that most other industrial countries have suffered also from poor growth. I suggest that any attempt to explain the slowdown in UK growth must look at issues that have been common to the major countries. We should also note that there has been considerable similarity in the conduct of monetary and fiscal policies. The chart shows the similarity of UK and US policy rates since the onset of the financial crisis in the very long period of almost zero interest rates in both countries. I find the similarity of them really quite striking. Of course, there are many other factors to consider in addition to monetary and fiscal policy if we are trying to find the answer to the slow growth rate. These include the strength of the industrial competition of China and other Southeast Asian economies. Just as Japan became a major competitor in the 1970s and 1980s, so we witnessed the impact of export-led growth of China. So my first question is whether the financial crisis and banking regulation has contributed to the slower rate of growth over the past 18 years or so. I think it's now widely recognized that the banking crisis of 2008 was the consequence of regulatory failure across the major countries, particularly in the US. Two red flags were ignored for too long. One was the extent of non-banks engaging in risky financial activities, such as credit default swaps, whilst holding insufficient capital against them. A second was the reliance on wholesale funding by banks, combined with an overconcentration of risk to commercial property and related assets. And once the US problems came to light, there was a severe liquidity crunch for UK banks, which coincided with fears of non-performing loans. I was a member of the board at Santander Group during this period. Fortunately, Santander were not caught in this crisis, in part because the Spanish regulator did require capital to be held against credit default swaps. This destroyed the profitability of this activity, and as a result, Spanish banks were not involved with them. However, following the crisis, I fear we have suffered the opposite problem of regulation. To ensure such a crisis would not be repeated, regulators in many countries initiated a sharp increase in the amount of capital banks were required to hold. In turn, this had a significant impact on the risk-weighted assets banks could hold from 2010 onwards. And again, I saw this at first hand. Basically, bank lending was constrained particularly to small and medium-sized businesses. The scale of the change is captured by a subsequent report, which I've quoted here by the FSA in December 2011. This reviewed the failure of the Royal Bank of Scotland. And the report notes that if Basel III definitions of capital had been in place before the crisis, RBS would have recorded a common equity tier 1 ratio at end 2007 of around 2%. This compares to an absolute minimum under the new standards of 4.5% and a higher level of 9.5% that the largest systemically important bank should hold during normal times to operate without restrictions on dividends and other distributions. Now, I'm not doubting the value of macroprudential policy, and a great deal of progress has been made in embodying this in the approach to banking supervision. However, in my view, two mistakes were made. The pre-crisis capital requirements were too low, while the increases required since the crisis have been excessive. This chart shows the outstanding amount of bank lending to the private sector. This shows the slump in bank lending to the private sector from the summer of 2009 through to the summer of 2016. Since then, there has been some recovery, but the level, and this is in cash terms, the level has only just reached the level of spring 2009. I find it difficult to avoid the conclusion that both the financial crisis and the regulatory response to it have contributed to low growth, low inflation, and low interest rates. I'm not suggesting that banking regulation is the whole story. Past evidence does suggest that banking crises are often followed by a slower recovery than from other recessions. And factors include the disappearance of banks, the impact of bad debts, the need to rebuild balance sheets, and the squeeze on the margins of banks from falling interest rates. All reduce the amount of capital available to support lending, as well as being a shock to confidence in investment. Next, I'll look at the operation of monetary policy since 2007, including the emergence of quantitative easing as an important policy instrument, and question why it took so long to identify the emerging inflation in 2022. A question I do ask myself is whether the success in meeting the inflation target over so many years, and it was a great success, did lead to an undue level of confidence among central banks in their ability to respond to inflationary pressures. As Mervyn King pointed out in giving this lecture in 2021, this led to policymakers giving too much weight to the effectiveness of the inflation target in reducing inflation expectations and insufficient weight to financial and money supply indicators. The combination of sustained low interest rates and low inflation may also have tempted central banks into this regime of so-called forward guidance, which we saw. Given my own experience of the margin of error around forecasts and the frequency of unexpected events, it's probably not surprising that I am no fan of forward guidance. For me, the strength of the inflation target lies in central banks being seen to act in response to deviations from it. Simply asserting that inflation targets exist and will be met is not sufficient to anchor inflation. Another consequence of the period of slow growth of bank lending to the private sector was the extended use of QE to support monetary growth. The chart shows the progress of both the outstanding level of bank lending to the private sector and to the public sector, and the total of both. Bank lending to the public sector is essentially the consequence of QE. The initial round of QE during the financial crisis was understandable as a way of reducing the risk of sharp monetary contraction. However, the chart shows the extent to which QE took on a longer-term run, seeking to fill the lending gap to prevent too much of a squeeze on money supply. My general thesis is that once the financial crisis was over, it would surely have been better if the capital requirements of banks had been less severe, stronger growth of bank lending to the private sector, we would have had a more balanced recovery and reduce the need to resort to the use of QE. From my perspective as an observer, this period between 2010 and 2019 was poor preparation for what was to come with the COVID crisis. The COVID crisis was a major challenge in many respects. I don't want to second guess the decision to have the original lockdown or the principle of furlough arrangements. However, the macroeconomic dangers of continuing to use public money to pay people who were not producing output and who could not spend their income were underestimated, as were the consequences of higher personal savings building up future excess demand. I understand the concerns about handling markets against the background of a large increase in public borrowing at the beginning of the crisis. However, engaging in large amounts of QE at very low interest rates has turned out to be very expensive, and too little attention was given to the monetary growth generated by QE. My view is that the first step should have been higher interest rates sooner. If there were difficulties in handling markets, QE could have been used once both short and long-term interest rates. The Bank of England policy rate, which is on this chart, did not move until the Ukrainian war started, and inflation was already above 5% and rising sharply. Undoubtedly, the Ukraine war was an added ingredient that reinforced the emerging inflation problem. However, as in the 1970s and 1980s, the impact inflation of the rise in energy prices would not help by the earlier rapid growth of money supply. My conclusion is that many of the monetary lessons of the 1970s and 1980s were not given sufficient weight following the financial crisis. The success in maintaining low inflation created over-optimism about the arrangements and the power of the targets. Success depends on the authorities reacting quickly when things go wrong and demonstrating willingness to make difficult interest rate decisions. And we ignore monetary developments at our peril, even if they do not always send the correct signal. Our final topic is fiscal policy, which has also been fundamentally affected by the banking and COVID crisis. The cost of bank rescues and recession meant that by 2012-2013, the debt ratio had more than doubled to around 80% and remained at this level for much of the decade following the crisis. And I've used this chart to show that there was, of course, an attempt to constrain the growth of public spending, and the notion of austerity gained a lot of coverage during that time. However, the weak growth of the economy meant that low growth of tax revenues at existing rates meant that although borrowing was reduced as a proportion of GDP, it was not sufficient to make significant progress in reducing the debt ratio and to begin to pay for the cost of the banking crisis. We can see from the chart the variations in borrowing are strongly affected by variations in spending. In keeping control of spending is critical. At the end of the decade, the debt to GDP ratio was still around 80%. The costs of the COVID crisis have now made this position significantly worse. We now have national debt close to 100% of GDP. This leaves the government with little room for maneuver if we were to face another crisis. And even without another crisis, there are future fiscal challenges we can already identify, from the cost of the transition to net zero, an aging population, and rising defense expenditure. My view is that much more should have been done earlier by raising taxes to begin to reduce the debt ratio, both in the period leading up to the COVID crisis and since. During lockdown, Alan Budd, Bill Robinson, and I spent hours online discussing Keynes's How to Pay for the War and the case, as we interpreted, for a temporary tax surcharge. Many people were at home being paid but producing less output, and most were consuming significantly less than they were earning. A temporary COVID income surcharge would have meant less government borrowing and less excess demand pressure afterwards. Participants in the current political debate about spending and taxation, for me, frequently fail really to address the costs of first the banking crisis and then the COVID crisis and how we arrived at the present position. These costs can't be wished away, and they do need to be addressed. I also doubt that we've been served well by the succession of budget rules that have been in operation since 2010. Successive governments have either failed to meet them or have wished to change them. And I've already stressed the perils of forecasting, and I understand the benefits of transparency and predictability policy. But if rules are too sensitive to unpredictable events, gains from the rules can easily be lost. Headroom built into the rules has been insufficient, hence the constant pressure to revise them. And on occasions when some margin has emerged, it's been used to ease taxes or to increase spending. Setting insufficient room for the margin borrower also leads, like now, to unsatisfactory periods of speculation ahead of budgets about the scope or necessity for further measures. One of the lessons I learned from the attempts to establish a new monetary anchor was that it was better to set a clear objective which is achievable and to which government is committed, rather than setting detailed short-term intermediate rules that are constantly revised. My own view is that the government's main fiscal goals should be set on a medium to long-term basis, and present circumstances should be aimed at reducing the ratio of national debt to GDP. At the same time, they could set out a path for other indicators that would be consistent, such as public spending, tax revenues, debt interest, etc. For me, the implications are clear. We need an aggressive fiscal retrenchment covering both taxes and spending to begin the process of reducing the weight of debt and to build more fiscal headroom into the rules that better reflects the margins of error in year-by-year forecasts. We also need to keep an eye on tax buoyancy. Over the years since 2000, we lost 2% of GDP through the failure of key taxes to keep pace with GDP. These include fuel duties, vehicle excise duties, tobacco and alcohol duties. Although in the case of tobacco, of course, this is in part due to falling consumption. None of this correction needs to happen immediately, but measures to reduce spending and increase tax rates should be legislated to come into effect over the course of Parliament. I conclude with one final thought. There are times when I think I can see quite a dark thread through these different aspects of policy since 2007. And that thread's as follows. The financial crisis and the subsequent overreaction contributed to the slowdown of the economy, the long period of low inflation and low interest rates. The resort to QE occurred at least in part to overcome the difficulty of further reducing interest rates already close to zero. Because inflation seemed dormant, the authorities ceased to pay attention to money supply and other financial indicators. This combination of low growth and low inflation made it difficult to make any significant progress in reducing the debt burden incurred in dealing with the financial crisis. With a starting rate of debt of 80%, we were ill prepared for the fiscal consequences of the pandemic. The reluctance to raise interest rates encouraged a further substantial round of QE with too little attention given to the consequences of monetary growth. This was a difficult background to deal with the supply chain disturbances and the energy crisis resulting from the Ukraine war. Inflation has been reduced, but remains above target. Meanwhile, the debt incurred to pay for the financial crisis and the COVID crisis remains an unsolved problem, an unsolved policy problem, along, I'm sorry to say, with the cumulative net mark-to-market losses that have been incurred by the QE program. Thank you very much.